Very good morning then to Hughg Hendry as well, who joins us around the desk. Hugh is CIO and partner at Eclectica. Good morning, Hugh.
Morning, John.
Nice to see you. Just very quickly then, give us the line. How do you see the markets?
I've no idea. No, I see the markets, clearly everyone is crowded into the markets. So my view on the market, to answer your question directly, is I think it's all one way, it's all one trade. There's no diversification. You're either in the market or you're not. I'm not.
How's performance then? I suppose I should ask.
Yeah, you can't make money if you're not. I'm a risk officer, if you will, okay? And if you find an environment where you can't diversify, if you find an environment where you have to share the trade with everyone, then the risk is that at an inopportune moment where you might have to exit that trade, you'll find that everyone is joining you. So that would be a point where your capital would be in jeopardy. I'm the second largest investor in my fund. Yeah, it's all of my capital. I've earned and I've accumulated this over the last 10 years, and I won't jeopardize my capital even for the rally as great as it is today. I won't jeopardize it to participate in a crowded marketplace.
You've just reiterated, obviously, what you've said is a very cautious, very defensive stance, which our viewers have become very aware of over the years. But my problem as well comes in that, as you say, a vast amount of liquidity. Everyone's into everything at the moment, very little discrimination. Do you fear that some of those more defensive trades which you've been advocating have seen a bit of money coming into them, so that actually when the market does turn around and these asset classes such as equities and corporate bonds and all these other ones which potentially have gone too far, do you feel that the asset classes you believe should benefit from their decline won't, because people have put money into those ones as well because there's just too much money around?
I don't think there's too much money around, and that's a contentious point to make, because this time last year the American central banking authorities increased the monetary base by 1,000%. And if you recall, when I've been on previously, I've been kind of pumped up with the debate, because, if you will, my intellectual opponents had maintained that inflation is a monetary phenomena, and last year we spent the period spraying the room with money, and therefore there would be inflationary consequences. Here we are 1 year down the road, and actually you find that bank lending continues to contract. Now, you're right in the sense that risk assets, inflationary assets like equities and commodities, have gone higher, and it gives the impression of this wall of money pushing it higher. The remarkable aspect, if you look at the stock market and the recovery from the March lows, is the absence of volume associated with it. If we are to say that March marked the historic low, we can then compare it with the lows of 1932 and 1975 and 1987, etc. And what you find is that the trading volume since March and over the summer are almost like 60–70% below the great turning points from history. So I don't believe there's a wall of money, and I certainly don't believe there's a huge queue of people wishing to buy risk-averse assets.
I struggle to break down these volume figures. I mean, you look at the headline figures, you're absolutely right. I mean, I look at the average daily volume on the NYSE, for instance. 1.5 billion shares is the yearly average. It's been around about 1.3 the last couple of weeks or so. But the problem is, below that, I don't know who's doing anything. Because there's so much high-frequency trading out there, program trading. I struggle to see, though, Hugh, even, as you quite rightly say, there's lower volumes, and that hasn't signalled what would be this wall of money, even within that, where the real money is.
Yeah, well, I think the conundrum, because the bulls will tell you, you better get in, because there's a lot of people sitting on the sideline. Maybe that's an interpretation of what I've just said. But they said that in 2007. You know, they said that all the people that had been chased out after the TMT collapse, that they were sitting on the sidelines and they would come in and they would propel the market higher. They didn't come in. And I don't think they'll come in this time, because the providers of money to fund managers, the private family offices, the last 10 years have been horrific. Yeah. Stock markets are no higher than they were 10 years ago, and we've had 2 incidences where 50% of your capital has been destroyed in a year. So the people with money don't want to give it to the guys who manage money. The guys who manage money are they're singing and clapping and very happy. People with money are like me. I've got money, and you know what? I'm not impressed. I like having money, and I fear that if I give these guys my money, they're going to lose it. That's what they've done for the last 10 years. So we're sitting pat.
Yeah, they all think they're heroes since March, I think, a lot of these guys. Right, let me have a look at one or two deals hitting the wires as well. First of all, let's have a look at what's going on.